Hi, everyone. I'm Jerry Davidsey, CEO of Presilium Private Wealth. Welcome to Financial Planning Fridays, our weekly video series on financial planning, where we work to simplify wealth management decision-making for our clients so they can focus on what is most important to them. Today, in our 18th episode, we wanted to talk with you about the yield curve and how it impacts where and how you should be allocating your money kept in cash and bonds. The yield curve is an illustration that shows the interest rate of bonds at different maturity dates. A maturity date is more simply known as the date on which you will receive your return of principal for any money you've invested in a bond. Typically, in the yield curve we see most often, the further out the maturity date of bonds, the more annual interest that bond pays the investor. This rewards you for taking on the risk of holding a bond until a date well into the future, where the unknowns of interest rate movements and credit risk come more into play. However, as of December 8th, 2022, this is what the Treasury yield curve looks like. As you can see, the yield curve looks very different than the more common one. It's currently inverted, which means that investors are being paid more to hold their bonds for a shorter period of time than a longer one. We see this type of curve most often when investors believe that rates may begin to fall in the future, and they are consequently comfortable locking in a lower rate for a longer maturity. As demand for these long-term bonds go up, the price goes up accordingly. Because a bond's yield is inversely correlated to its price, the yield curve inverts. As you can see, a one-year Treasury bill is yielding about 4.7%, while a 30-year Treasury bond is only yielding about 3.5%. Because of this, and wanting to maintain flexibility, here at Presilium, we are continuing to keep the bond portion of our clients' accounts in short-term, high-quality bonds. This is a situation that we will continue to monitor and evaluate for you as we look for an opportunity to increase the yield on your bond positions. Thank you for joining us today. Ahead of wrapping up, we also wanted to call attention to a recent article published in the Wall Street Journal. The article, similar to our discussion in the 13th video in our Financial Planning Friday video series, highlights how the American public is unfortunately earning much less interest on their savings than they probably should be. While the 5 largest banks in the United States hold nearly 50% of all funds kept in banks, they were only paying an average of 0.4% on those deposits, a missed opportunity totaling nearly $42 billion in interest for those Americans. You can find the link to both our video and the Wall Street Journal article in the description of this video. Thank you again. Have a wonderful weekend, and we look forward to talking with you again soon.